A Random Walk Down Wall Street. Number 3, the Japanese Bubble and the Internet Bubble. Hello everyone, welcome to the AI Finance 101 reading series. I'm Miss CSPX. In our last session, we reviewed the South Sea Bubble of the 18th century, the Babson Crash of 1929, the Electronica Frenzy of the 1960s, and the M&A and concept stock craze, revealing how popular mania led to market crashes. Today, we will continue our study of A Random Walk Down Wall Street by discussing the Yen Nifty 50. Of the 1970s, Japan's real estate and stock market bubbles, and the internet bubble and subprime mortgage crisis of the early 21st century. Today's content includes 4 sections. 1. The Nifty 50 and the biotechnology frenzy. 2. Japan's real estate and stock market bubble. 3. The madness of the internet bubble. 4. The roots of the subprime mortgage crisis. Let's dive into today's lesson. First section, the Nifty 50 and the biotechnology frenzy. In the 1970s, Wall Street attempted to return to rational investing, with blue-chip stocks replacing concept stocks as the new market favorites. At the time, high-quality growth stocks such as IBM, Xerox, Swab Alvon, McDonald's, and Disney were referred to as the Nifty 50 Mandasetis, with about 50 companies considered safe bets. However, investors overlooked one key principle. No matter how good a stock is, it won't make money if you buy it at an inflated price. In 1972, the PE ratio, of the Nifty 50, reached 80 to 90 times. But by the 1980s, it had fallen to around 10, resulting in significant losses for investors. In the 1980s, the market shifted to biotechnology stocks with a focus on interferon, an anti-cancer drug. Analysts predicted sales would surpass $1 billion in 1982, but by 1989, sales only reached $200 million. Despite this, biotechnology stocks saw their valuations skyrocket, and many lost up to 3/4 of their value. This highlights that even real technological revolutions might not lead to investor profits. Second section, Japan's real estate and stock market bubble. A more recent example is Japan's real estate and stock market bubble. From 1955 to 1990, Japanese real estate prices increased over 75 times. And by 1990, the total market value of real estate was approximately $20 trillion. Or 20% of global wealth, twice the value of the global stock market. It was humorously said, sell Tokyo and you can buy the US. During the same period, the Japanese stock market soared over 100 times, peaking in 1989, when its market capitalization accounted for 45% of global stock market value, and the average PE ratio was over 60 times. At that time, Japan claimed that high P/E ratios were justified because of high depreciation costs and the exclusion of affiliate company profits, while high real estate prices were attributed to limited land and many people. But these justifications were flimsy. In 1990, the Japanese government attempted to soft land the bubble by tightening credit and raising interest rates, but it failed. The stock market crashed from 40,000 points to 14,000 points by 1992, a 63% drop, and the real estate bubble burst, with no full recovery to this day. Third section, the madness of the internet bubble. In the early 21st century, the United States experienced the internet bubble. Between 1998 and 2000, the Nasdaq index more than doubled, with many stocks having PE ratios exceeding 100 times. Great companies like Cisco had market valuations near $600 billion. And if they maintained a 15% growth rate, their market cap would surpass the entire US economy in 25 years, which was clearly unrealistic. The market saw a rerun of the name-changing trick, where companies could boost their stock prices by adding internet to their name. In Q1 2000, venture capital poured $15.7 billion into 1,009 startup internet companies, many of which had no actual business operations. For example, a company claiming to produce internet toilet paper still managed to attract capital. New valuation metrics emerged, where internet companies were valued based on web page views or fiber optic length, leading to a waste of resources, such as telecom companies laying down excessive fiber cables. After the bubble burst, $1 trillion in telecom stock investments evaporated. Nortel Networks saw its stock price collapse from $1,000 to $3 in 2002. Enron became one of the most famous scandals due to its financial fraud, making it the most infamous example of the bubble. Fourth section, the roots of the subprime mortgage crisis. After the internet bubble, the U.S. soon faced the subprime mortgage crisis, and its roots lay in the changes to the banking system. Traditionally, banks issued and held mortgages, rigorously screening borrowers. However, new financial derivatives, specifically mortgage-backed securities (MBS), changed everything. Banks bundled mortgages into securities and sold them to investors, categorizing them based on risk. While this helped spread risk, it did not eliminate it. Later, credit default swaps (CDS) emerged as insurance, allowing third parties to speculate. CDS contracts could be valued up to 10 times the underlying bond's worth. During the U.S. housing boom, many believed home prices would always rise, and no one anticipated defaults. Banks lowered lending standards, leading to a surge in subprime mortgages, high-risk loans. When defaults began, the CDS contracts could not be honored, triggering a systemic crisis. This is how the subprime mortgage crisis originated. Summary. Today, we've covered Chapter 3 of A Random Walk Down Wall Street, focusing on the Japanese bubble and the internet bubble. We first reviewed the Nifty 50 Bumingstee and the biotechnology frenzy, highlighting the risks of inflated valuations. Then, we explored Japan's real estate and stock market bubbles, showing the consequences of excessive optimism. Next, we analyzed the madness of the internet bubble, where absurd valuations led to vast resource waste. Finally, we revealed the roots of the subprime mortgage crisis, stressing the dangers of financial derivatives amplifying risk. These cases remind us that irrational exuberance is not uncommon, and even modern financial systems cannot fully protect against it. So, how did the subprime mortgage crisis unfold and affect the world? Next episode preview. That's it for today. In our next session, we'll continue our study of A Random Walk Down Wall Street, diving deeper into how the subprime mortgage crisis only erupted and its global impact, as well as how we can learn from these historical bubbles. If you enjoyed our AI Finance 101 reading series, please share it with your friends and invite more people to join our learning journey. I'm Miss CSPX, and I'll see you next time.